Hello traders, welcome back to the comprehensive course on options trading. In the previous episode, we have talked about the 7 factors influencing the price or premium of an option. At the very end of that video, I have shown you a calculator that determines the price of an option when fed with the 6 values. The values that must be inputted into the equation to calculate the output are the underlying price, strike price, time to expiration, volatility, interest rates, and dividend in case of stocks if applicable. Out of the 6 variables mentioned, only one variable remains constant throughout the life of the option contract, which is the strike price. The rest of the variables fluctuate over the life of the option. Hence, whenever option price changes, it is usually due to a change in the value of one or more of these 5 variables. Anyways, when we press the calculate button, the result comes up. And as anticipated, we get the premiums for call and put options. But that is not it. It returns some other values like delta, gamma, theta, rho, and vega. What are these? To give you a heads up, these are market forces that influence the option premiums. For an option trade to be successful in the market, some or all of these factors need to work in an option trader's favor. These forces are collectively called as the option Greeks. To put it simply, option Greeks are forces that measure the sensitivity of an option price to the changes in underlying price, time, volatility, and interest rates. The values for each of the Greeks are derived from various mathematical models like the Black-Scholes-Merton option pricing model that we have discussed. All these values are combined to arrive at a theoretical price of an option. These Greeks influence an option contract in real time, affecting the premium to either increase or decrease on a minute-by-minute basis. To make matters even more complicated, these forces not only influence the premiums directly, but also influence each other. Just try and imagine this. The option Greeks influence the option premium. However, the option Greeks itself are controlled by the markets. Therefore, as the markets change on a minute by minute basis, the option Greeks also change, and so will the option premiums. Okay, let me give you an analogy. Think of a ship sailing in the sea. Let's assume the speed at which the ship sails is equivalent to the option premium. Now, the speed of the ship depends on various forces such as wind speed, seawater density, sea pressure, and the power of the ship. Some of these forces tend to increase the speed of the ship, while some others tend to decrease the speed of the ship. The ship battles with these forces continuously and finally arrives at an optimal sailing speed. Likewise, the premium of the option depends on the option Greeks. This means some option Greeks tends to increase the premium while some try to reduce the premium. Crudely put, option premiums, option Greeks, and the natural demand supply situation of the markets influence each other. Though all these factors work as independent agents, yet they are all intervened with one another. The final outcome of this mixture can be assessed in the options premium. In other words, when you put the 6 values in the Black-Scholes-Merton option pricing formula, it employs these forces and converts these forces into a number, which is actually the premium of the option. So, as an options trader, assessing the variation in premium is most important. You need to develop a sense for how these factors play out before setting up an option trade. You have to compare this theoretical price obtained from the formula with the actual price of an option to see whether the option is underpriced or overpriced. Also keep in mind that option Greeks only provide values based on the numbers that we have inputted in the option pricing calculator. Hence, any incorrect value being inputted could lead to an incorrect output being generated. Even with that being said, understanding option premiums helps you get answers for a lot of common questions like why do premiums vary? What is the basis for the change in premiums? How can someone predict the change in premiums? How is the price of a particular option decided? So on and so forth. So without a lot of suspense, let me introduce the Greeks to you. These Greeks are delta, gamma, theta, vega, and rho. Let us now try to understand in brief what each of these Greeks stands for. Keep in mind that in this episode, I will only introduce you with the option Greeks. I won't talk in much detail about each Greek as this would be done over the course of the next few videos. For now, we will only see a short definition of each of the option Greek so that you have a basic idea of the Greeks. Anyways, let's start with delta. The term delta comes from the Greek symbol delta. Delta measures the rate of change in an option price based on a 1 point change in the price of the underlying. So, to put it simply, delta measures the speed at which the price of an option changes for a change in the underlying price. Now, when it comes to gamma, the term gamma comes from the Greek symbol gamma. It measures the rate of change in delta based on a 1 point change in the price of the underlying. To put it simply, gamma measures the pace at which delta of an option changes for a unit change in the underlying price. Moving on, the third factor is theta. Yet again, the term theta comes from the Greek symbol theta. It measures the change in the option price based on a change in the time to expiration. In simple words, theta measures the rate at which the option price loses its value due to the element of time decay. Now, let's talk about Vega. The term Vega is commonly denoted using the symbol K. Vega measures the change in an option's price based on a 1 point change in the underlying asset's implied volatility or IV. So, to put it simply, Vega measures the sensitivity of options price to changes in the volatility of the underlying. Now, the final Greek is rho. The term rho comes from the Greek symbol rho. Rho measures the rate of change in an option's price based on a change in the risk-free interest rate. In other words, rho measures the sensitivity of an option price to the changes in interest rate. Now that we have a very basic understanding of what each of the five Greeks represent, it is time to focus on each of the Greek in a much greater detail, which is something that we would be doing over the course of the next few videos. So in the upcoming episodes, we will understand each of these forces and their characteristics. We will understand how these Greeks get influenced by the markets and how the option Greeks further influence the premium. So, our main objective is to get a sense of how the option Greeks influence premiums. To figure out how the option premiums are priced, considering the option Greeks and their influence, and finally keeping the Greeks and pricing in perspective, we have to learn how to smartly select the proper strike prices to trade. So this was just an introduction to the world of option Greeks. I hope all of you are now ready for this journey. If these series of videos are helping you get better in trading, then kindly consider supporting our efforts by liking and sharing this video. Help this video reach the target likes. Also drop in comments regarding any doubts or queries that you have so far. And if you are new to this channel or you have not yet subscribed, please do subscribe and also enable the bell notification to stay updated on our future videos. I will see you guys in the next episode. Till then, bye.